The Reserve Bank today left the cash rate at 3.25%. This was, I think, an unexpected move by a lot of economists in the market, and money markets themselves were factoring in a cut of around about 0.25%. In the aftermath, the share market has sort of stabilised at about 4,500 points and a bit. The banks were the main gainers. Most of the banks are up apart from Commonwealth Bank. If we look at the currency, that's now about a bit over $1.04 US, so there's been a bit of strengthening there. The markets, we look at the cash markets and the bill rates, they've increased in rates by about 0.1%, so which suggests that a further cut is now not seen as likely and probably till well into the new year. Interesting, the cash futures are now looking at cash rate rises, probably taking place through 2014. But in the meantime, the cash rates are still factoring in a further cut in the cash rate to something in the order of 2.5, 2.7%. But that'll be sort of looked at for the markets by sort of late 2013. The impact on retail investors, I think, is going to be mixed. I think the banks obviously are not going to be moving on variable rate home loans, although I believe there's likely to be some further slight falls in both fixed rate home loans and also in the sort of 3 to 6 month term deposits. And that's off the back of the banks now being not as dependent on increased retail funding as they have been probably 6 to 12 to 18 months ago. So we heard from ANZ a couple of weeks ago that they've got a fair proportion of their 2013 wholesale funding out the way. So I think the big banks themselves are not going to be as competitive on term deposit rates, so we could well see a further easing, particularly in the 3 and 6 month rates over the next couple of months. The Reserve Bank said that the reason not to move was really based upon waiting to see how the impact of the earlier rate cuts flowed through. But they also noted that inflation was a little bit higher than expected when they made the last cut back in October, and that also growth, particularly in the rest of the world and to a degree here in Australia, was a little bit stronger. So I think the Reserve Bank is now saying not that there won't be further rate cuts, but they're really just not needed at the moment, and I think they'd like to keep their powder dry for bigger rate cuts in the future if that's really needed, if the world economy and the Australian economy turn down a bit faster than expected. But at the moment, no rate cut. I don't think we'll be seeing one now, probably until February, and I think the likelihood is that we're very close to the end of the easing cycle.